Hello, and thank you for joining the Center for Financial Security during Money Smart Week for our webinar, The Effects of Access to Banking Services on Elementary Students' Financial Learning, a Field Study. My name is Hallie Leinhart. I'm the Outreach Specialist for the Center for Financial Security here at the University of Wisconsin-Madison. To give you just a bit of a rundown on our format today, we will start with the research presentation and then move into discussant portions with representatives from the FDIC and UW Credit Union sharing insights and experiences in this space of banking and schools. We will then continue with a question and answer session. So please feel free to submit questions in the box at the bottom of your screen throughout the webinar. I'm very excited to introduce our presenters for today's webinar. Madeline L'Esperance is a doctoral student here at University of Wisconsin-Madison, and she's a graduate research fellow with the Institute for Research on Poverty. Luke Reynolds is Chief of Outreach and Program Development in the Division of Depositor and Consumer Protection at the Federal Deposit Insurance Corporation, FDIC. And Steph Harrell is Community Partnerships Coordinator with UW Credit Union. Thank you all so much for being here today. And with that, we will get started, and I will turn it over to Madeline.
Thank you, Hallie. Good afternoon, everyone. As Hallie mentioned, I'm Madeline L'Esperance. I'm a doctoral student here at the University of Wisconsin-Madison, where I worked as a project assistant for the Center for Financial Security. And part of that work was this project with Michael Collins and Elizabeth Otterswhite, looking at the effects of the access to banking services on elementary students' financial learning. So first, I'll discuss the background and motivation for this study. I'll give you a little bit of detail about the design of the field study, the study sample characteristics, some findings from the study, and then I'll conclude with a summary and some implications from this work. Okay, so the OECD had fielded the Program for International Student Assessment, the PISA study, and in their 2012 version of the PISA study, they added an assessment of financial literacy to the assessments that they had on mathematics, science, and reading. And they look at how 15-year-olds, how well they do on these assessments. So this graph just shows you some of the results from that financial literacy assessment. So we can see here that students who have bank accounts have a higher measured financial literacy than those who don't. So here we're looking at differences between those students. And we can see that in the United States, the difference is just about at the OECD average, so the average of countries that are part of this study. And if we dig a little bit deeper into this data, they found that more advantaged students were more likely to be banked. So students with a higher socioeconomic status were more likely to hold a bank account. And we can see in the US that students are 6 times more likely to have a bank account, about 3 times the average for OECD countries, and that SCS is playing a larger role in the banking status of these students than in many other countries that are evaluated by this study. So from these two findings from the PISA study, we can see that banking and financial literacy seem to be related in some way. Banking is influenced by the socioeconomic status, particularly in the US. So investigating this relationship between banking, having a bank account, and financial literacy will be really one of the aims of this study, trying to dig deeper into this relationship. And we want to better understand how access to banking services influences financial literacy and also children's attitude towards banks and savings as well, which I'll get into in just a moment. So some of the motivation for the study, so many children are unbanked. Some of the latest statistics from the Federal Deposit Insurance Corporation's National Survey of the Unbanked and Underbanked in 2015 found that 7% of households are unbanked. And this represents about 15.6 million adults and 7.6 million children who are not banked. And they note that this is likely an underestimate of the number of unbanked individuals because they are surveying households. So we can see that there are a lot of children who are unbanked in the U.S. and that we saw before that this is in part influenced by socioeconomic status. So we might think that one of the potential drivers of these differences is differential access to financial services as a child, and that this access could have impacts on financial literacy attitudes towards finances and financial institutions, and also other later life outcomes like health and other things that have been shown to be associated with saving throughout the life cycle. We also might think that building a savings habit earlier on in life could have some longer-term benefits. You're building up this behavior where you are able to accumulate funds in the earlier term that you can then pull from later if there's some kind of emergency or you want to make an investment in your education or some other type of investment. It's also possible that children can learn from these experiences early on using financial services. They can apply some of the financial knowledge that they might gain in school or from their parents or peers. It also can foster trust in banks and credit unions that will maybe mitigate some of the unbanked the rate of unbanked that we see in the U.S. today. And these children also gain familiarity with these financial services and can learn about the different services that banks and credit unions offer beyond just savings accounts that they can then use later in life. Okay, so some of the policy responses to the financial literacy of young children, and also the banking status and the unbanked status of many of these children have been financial education largely, and also some countries have implemented children's savings accounts. So in the UK, Canada, and Singapore are just some of the countries who have implemented savings accounts for children, especially for children. Some of them at birth with an initial seed deposit. Some have matching deposit features that make these attractive for children and parents to save during their child's life. In the U.S., there have been some similar types of initiatives. So the individual development account is one example where people were given accounts and then matched deposits. There are also 529 plans and other structures that are there that children can use to save, but it's not an initiative that is accessible to all children in a very systematic way. And there have also been some efforts by the FDIC and the Treasury to support banks delivering financial services to distressed areas. So this comes in the form of financial education, special accounts for children, and also partnerships with schools to provide access to services at school or near school to mitigate some of the unbanked trend that we've seen. So the question that we're interested in for this study is whether increasing access to financial services for children can encourage children to save, and also if there are any improvements on financial learning from this increased access to these services. So just a little bit more background on banks and schools, if you're not familiar with this, and we'll also get some of this from our discussants as well, I'm sure. So bank and school programs have existed for well over a century. So there was one New York Times article back in 1917 that showed that children in New York City public schools had deposited hundreds of thousands of dollars through their school savings institution. And we see school savings programs in place all across the United States in different forms. And we see state and local initiatives to put in place a variety of in-school banking programs that offer low-cost savings to children. And one of these models is for students to save at in-school branches that often have features like basic account services, the ability to deposit, withdraw, and check your balance, hours during the school day. So the bank branch is open during the school day, maybe at lunch or after school. There are prizes for some of these accounts. Many programs offer students the ability to work as tellers in the bank alongside bank employees. And some also feature financial education to accompany the account services that they provide. So thinking about what are some of the mechanisms underlying increasing access to financial services. So we might think that in-school savings programs increasing access to financial services will address some barriers to savings for children. So first, they might lower transaction costs related to saving at a bank or credit union. The services are provided at school, eliminating time to travel to a bank, maybe negotiating with parents to take them to the bank to set up an account and make deposits and use the services of their bank. These accounts are also low cost, as I mentioned before, and they have some. They might have some restrictions to the activities that can be done, so that children are able to use these services and not get into any trouble with fees or anything like that that we might worry about with them using these accounts as children. Also, increasing access through these in-school bank programs can increase trust in the banks or credit unions through a few potential channels. So first of all, the children just get some exposure to using these financial services at school in a more controlled environment. There are partnerships with the school, so this might send signals to the parents perhaps that this is a good quality bank or credit union to use, and that the accounts that they provide are of good quality and they're trusted by the school and its administrators. The tellers are classmates often, so this might limit some of the feelings from children that banks are not for children and that the services that they provide aren't really useful to them. They also can learn that banks are a safe place to store their allowance or other money that they receive that they might otherwise store at home in a piggy bank or something like that, because they're able to go and check their deposit and they can return to the bank and make sure that their money is there if they want to. So they can learn that way. These bank branches also give students a chance to apply some of their financial knowledge as well that maybe they've gained from financial education in school or perhaps from financial socialization from their parents or peers or others throughout their life. So now I'll give you a sense of the field study now that I've given you some background on these bank and school programs and a little bit of motivation for why we were interested in this topic. So we'll look at a field experiment that features an in-school savings program at 2 U.S. school districts, one in Eau Claire, Wisconsin, and the other in Amarillo, Texas. And this study took place during the 2011-2012 and 2012-2013 academic years. So in both years in Eau Claire and then just in 1 year in Amarillo. So we'll follow students over those 2 school years. And we're looking at 4th and 5th grade students at these 2 school districts. And the study included an in-school savings program provided in partnership with a local financial institution. And the in-school savings programs were already established in Eau Claire with a local credit union. So they were already in place in the schools. And then in Amarillo, Texas, we were able to randomly assign the savings programs to the schools so that, and that's what we'll use later to kind of look at what the effects are of these programs with some kind of randomization in place of the program. In Amarillo, students were also randomly offered a $25 seed deposit to encourage them to open an account. So that's another feature that we had to the study that we'll explore. And students were also randomly assigned by their classroom to receive financial education. And this financial education program was modeled after the MoneyFit program, where students receive 1-hour workshops on different financial education topics over 6 weeks of the school year. So to give you a few more details about this particular in-school savings program, so the picture you see here is the children receive a savings pouch at, in the Eau Claire study, they receive this savings pouch from the credit union to put their money in to bring to the school bank. And they also receive the card that you see below that, which tracks their deposits. And every 4th deposit at this particular school, they received a prize for making 4 deposits. So each time they make 4 deposits, they received a prize. And they're able to track that and track their deposits over time. The school branches were open once a week outside the cafeteria. Deposits can be made, or were able to be made of any amount, but withdrawals had to be $20 or below. They were encouraged to identify a savings goal and track progress towards that goal, and one of those tools was this card that we see here. They received prizes, as I mentioned before, and they had student tellers who processed their deposits along with the staff of the credit union or the local financial institution that was partnered with the school. Here, I wanted to just give you a sense of what these 2 school districts look like. So students in Texas, as you can see from this chart, are less active savers relative to the students in Wisconsin. So they're less likely to be banked at baseline. They're also less likely to know that their school lets them save, to be aware that they have the ability to save at school. And fewer of them actually save at school as well. In terms of the other characteristics that we look at here, we see that students receive allowances at pretty similar rates. They may have jobs at home or outside of the home at similar rates as well. And finally, we see that their financial knowledge is pretty similar. So we really don't see much of a difference between the 2 districts in terms of their baseline financial knowledge. And I just wanted to note here that in Wisconsin, we're looking at 650 students, and in Texas, we're looking at 609 students in this study. Here I can give you a sense of what the actual banking activity in the school looks like. So we can see that the average deposit amount that students are putting into their accounts at school are, most of them are below $5 at a time. And we see that in the bottom part of this graph, we see how often students are going and making deposits at the school bank, and we see that most students are using the bank about 10% of the time that it's open. So they're making small deposits, and they're making these fairly infrequently relative to how often the bank is open. And this varied a lot between the two districts. So we did see some differences there. This next graph gives you a sense of the student's likelihood to have an account when there's a bank in school. So we can see here there's a strong positive and statistically significant association between having a bank in school and being banked. We also see that having the seed deposit, so receiving the seed deposit in addition to the bank in school, has a positive relationship with banking status. So those students in Texas who have a bank in school and are randomly assigned to the seed deposit are seeing an additional bump in their likelihood to bank at school. Okay. One thing to note about the placement of the banks in schools and some characteristics of the schools that they're placed in. So in Wisconsin, as I mentioned, the savings program at school was already in place. So the program was already set up before this study took place, and we started tracking these students. And we can see that more affluent socioeconomic schools were more likely to have banks in schools in Wisconsin. And we don't see the same relationship in Texas, where the banks in schools were randomly assigned. So we see that there's also a lower rate of bank and school accounts in Texas relative to Wisconsin. So there are more students who are banked in Wisconsin, as we saw, than in Texas. But the distribution of the bank and school programs is more even in terms of socioeconomic status in Texas versus Wisconsin, where the bank and school program was already in place. And the survey questions that we look at as outcomes for the study. So we're going to look at how kids feel about saving money. So some kids feel that saving money is only for adults. How often do you feel that way? We'll look at that outcome. We'll also look at how kids feel about bank accounts, whether bank accounts are appropriate for them as well. So we'll look at some kids feel that bank accounts are only for adults. How often do you feel that way? And we'll look at whether or not there is an influence of the bank and school program on receiving pocket money or an allowance. So perhaps parents feel a little bit more comfortable giving their child an allowance, or their child maybe negotiates for an allowance, or whatever the case may be, because now they have a safe place to store their money at school. And finally, we look at a 13-item financial literacy quiz score to see if the bank and school program has any impact on financial knowledge. So we use the fact that students are assigned to a school with a bank and school program. So in Wisconsin, parents are choosing these schools, and it's not very likely that they're choosing the school because it has the bank and school program. And in Texas, the banks are installed, are put in place after the children are already enrolled in the school. So it's unlikely that the children and their parents are switching schools because there is a bank and school program at another school, so they go to that one. So we're using this, variation in the placement of the bank in schools and our knowledge of some of the characteristics of these schools in order to estimate the effect of the access to the bank and school program on these different outcomes. So in the next few graphs I'll show you, the left bar, the black bar that you see will represent the pooled sample. So that is both the Wisconsin and Texas studies together. So the effect of those studies together. And then the right bar, the gray bar, will show you the effects in just the Texas study where we had random assignment of both the bank and school and the seed deposit lottery, where the variation in the bank and school is controlled more by the study design than in Wisconsin. So as we can see from this first graph, we see that there is a small positive but insignificant impact on savings attitude from the bank and school program and the seed deposit. So we don't really see a significant effect here, but the direction is positive. And also it's important to note that students already had a pretty high score on this attitude at baseline, so they already really felt that savings was for children as well as adults. So there was less room to really move on this measure than some of the other ones. But we still see a positive effect here, although insignificant. Next, we look at how children feel about bank accounts and whether they feel like these bank accounts are for only adults or if they're appropriate for children. And we see here that there is a positive effect of the bank and school program on this attitude towards bank accounts and feeling that they are not just for adults. And we see that this is about 2/3 of a standard deviation effect here. So and it's similar across both of the pooled sample as well as the Texas study alone. And this could mean that children are moving from feeling that savings accounts are for adults that they feel this way less of the time than they did before they had access to the bank and school program. So as I mentioned before, we also looked at whether or not the bank and school program impacted the receipt of an allowance or pocket money. So parents, as I mentioned, might be more comfortable giving their kids an allowance because they know that they now have a safe place at school to deposit it and keep track of it and build a savings habit that way. And we see a positive effect on this measure in both the pooled and so Wisconsin and Texas together, as well as Texas on its own in that right bar. But we see that this effect is larger and also statistically significant in Texas only, with about 10 percentage point students being 10 percentage points more likely to receive an allowance in the Texas study when they have this bank in school. Finally, we look at financial knowledge. So we use a financial literacy quiz score that was designed for the study that has 13 items that measure things like trade-offs and making a savings plan, opportunity costs, and other economic and personal finance concepts. And we see that there is a positive effect of the bank and school program on this quiz score, but it is statistically insignificant in both the pooled sample as well as the Texas sample on its own. And we really see a much smaller effect size, insignificant effect size in the Texas study when we look at that in isolation. We also looked at whether there was any kind of interaction between the financial education that I had mentioned earlier that was randomly assigned by classroom and the bank and school program, and we see a positive but small and insignificant interaction of those two. So financial knowledge gain in this study is really driven by financial education rather than the bank and school program or the interaction of those two facets of this study. Okay, so now I will give you a quick summary and then some implications now that I've presented the results of this study. So we use survey and administrative data from savings accounts to compare students with and without an in-school savings program. And we saw that there was a higher rate of bank students, particularly in Amarillo, Texas, where students were less likely to be banked at baseline. We saw that students gained more positive attitudes towards bank accounts, feeling that bank accounts are not only for adults, but also for children to use as well. We saw increases in allowance receipt in Amarillo, Texas. And finally, we saw positive but insignificant impacts on attitude towards saving and financial knowledge from the bank and school program itself. So thinking about some implications for this study, so these bank and school programs are a tool to encourage saving at an early age and to address some of the lack of access to banking services and maybe to address some of the gaps in by socioeconomic status in the rate of children who are banked at an early age. These programs increase access to financial services for students by lowering some of the barriers to saving, like traveling to a bank and having parents take you to a bank to deposit money and check your balance and perform other financial services. Children also learn how to use a savings account, and they learn more about banks and credit unions more generally and become more familiar with those institutions. And it also, we found that it also encourages parents to give their children money to save at school. So it's encouraging some financial socialization beyond that happens beyond just the classroom, and we see some interaction with parents getting involved with these programs as well. So that is all I have to present, and I will turn it over now to the discussants. Thank you.
Okay, good afternoon or good morning, everyone. My name is Luke Reynolds at the FDIC. Going to share a little bit about youth savings and youth banking from the FDIC's perspective after that wonderful presentation. So just as background a little bit, we know that financial institutions, and that includes banks and credit unions, often work with schools to help young people receive financial education. We know less often, but we know that often, that financial education is enhanced through access to safe, affordable savings accounts. But we know that oftentimes institutions struggle with the best way to link their youth savings opportunities to their financial education opportunities. We conducted a 2-year pilot program where we studied 21 financial institutions, very diverse financial institutions, on how they connected financial education to opportunities for school-age children to open and maintain a savings account. We had a fairly detailed methodology, which included over 90 one-on-one calls with banks and their school partners, site visits, among other things. That led to the release of our report in 2017, which identifies promising approaches and lessons learned from combining financial education with the opportunity to open a savings account. This report defines a wide range of models that offer financial institutions flexibility to adapt to varying opportunities to promote youth savings. And one of the things we learned from that pilot, interestingly, was that the benefit of a youth savings program goes far beyond the dollars and cents that get deposited into the school-age children's accounts. For example, teachers have recognized that youth savings programs have strengthened academic success in related subjects such as math. Bankers have shared that community involvement is central to their mission, and nonprofit partners have stated that youth savings activities are complementary to their financial to their financial capability or community engagement or economic empowerment or affordable housing. The list can go on efforts. And then, of course, banks can also potentially receive positive consideration under the Community Reinvestment Act if they provide youth savings and financial education programs primarily targeted at low and moderate income students. And banks and credit unions can build a pipeline of future customers. One bank described its youth savings program as a long-term investment in future customers. And oftentimes these accounts can show up in the short term, other times over the longer term. Our pilot led to development of a roadmap that has 5 stages and that we offer for your consideration as you explore how to initiate a youth savings program. I'm just going to walk through the roadmap pretty quickly. The first step of that roadmap is first step of a planning process to initiate a new youth savings program is to plan. One of the first steps is to identify objectives. And objectives may not be just to help young people save. It could be something such as advancing college savings or engaging families and getting families and parents more involved. The objectives of the youth savings program can be broad at times. From there, the next step is to engage partners. One of the questions that I get and my colleagues get a lot from banks is how do we work with schools? And equally we hear from schools, how do we connect with banks? One of the things that we heard from the participants in our pilot was leveraging existing personal and professional relationships. Maybe a teacher approached a local branch manager, maybe a bank officer was on the local school board and discussed the idea, or in some cases, maybe a nonprofit is working with the school and there's an opportunity to integrate financial capability into healthy food or healthy eating or a completely unrelated subject. Next step is to think about program design. 3 important decisions that go into program design include selecting an appropriate program model, selecting an appropriate ownership structure, and then the approach to financial education. The 3 basic models we saw were in-school branches where there's on a pretty regular schedule, a financial institution manages the collection deposits on the school premises. Oftentimes, students have a lead role in operating these branches. Sometimes not, but oftentimes they do. Second model are in-school banking programs where there's not a physical dedicated space, but bank staff on a regular schedule go to collect deposits in a common area of the school. It can be a cafeteria, it can be on a set day, it can be once a week, it could be every 2 weeks, but there's a fairly regular visit from a financial institution on a set day in a common area. And then the last strategy are where a bank will go in and provide financial education and encourage students and their families to visit a nearby bank branch. We saw a pretty good distribution between the 3 models in our pilot. From there, it's important to identify the rules regarding the establishment of one of these programs. I'm going to talk a little bit later about interagency guidance, but before I get there, There's a resource that the Conference of State Banking Supervisors developed. We worked with them to develop this resource where you can go to see key state laws that pertain to school-based savings programs in the state-by-state basis. So, for example, you can see whether or not Wisconsin has a state law that relates to school banking programs. From there, the next step is to think about what the characteristic is of accounts that will be offered. We saw that they can be structured, normally structured in 3 ways. There are a couple other ways too, but the 3 common ways we saw were non-custodial accounts, which basically means students are the owners of the accounts. Custodial accounts where a parent or guardian is the custodian. Banks often offer these when they're trying to engage parents in the program, since parents have to be an active participant in the account ownership life cycle. And then custodial accounts where there may be a trust or a custodian or a nonprofit partner who is the custodial accounts where there may be a trust or nonprofit partner who is the custodian. These are often done to advance a goal such as college savings. Other key elements of the accounts included that they were consistent with the FDIC's Model Safe Account template and the use of mobile technology, which is very well received from students. As you go about to design a program, it's important to remember that the FDIC, Federal Reserve Board, Office of the Comptroller of the Currency, and the National Credit Union Administration work with the Financial Crimes Enforcement Network to release interagency guidance in 2015 to encourage financial institutions to use savings programs and answer questions that come up along the way, such as, can we open an account to a minor? What are the branch application rules for an in-school bank branch? What are some key elements of customer identification that relate to in-school savings programs? Financial education delivery, interestingly, we set out, I was thinking, well, financial education is probably always going to be classroom-based. We were surprised. Financial education is delivered in a broad array of ways, not just formal education, but also peer-based, particularly in programs where students have a lead role in the school-based program. Students are used to provide peer-based training. The bank trains students, and then they either coach or talk to their fellow students, or sometimes teachers call upon them. And then some banks have a strategy of just-in-time information sharing. There's not a formal curriculum being taught, but the bank and their staff explain key decisions during the life cycle of the account. Banks use an array of curricula, including our Money Smart for Young People, which has components to engage students, teachers, and parents and caregivers. Another piece of the roadmap, you'll see some key roles and responsibilities and some strategies for thinking through the roles and responsibilities. The implement stage is a lot about training and identifying ways to communicate and involve parents. And then lastly, assessing and refining. This is the last step in our roadmap, but it's not necessarily the last step you would think through. Oftentimes you want to give some thought to this at the front end. But again, communication is important, including with the students, parents, and school. We have launched a youth banking network. It includes about 65 financial institutions that are working to connect financial education to savings accounts for school-aged children. We talk with them fairly regularly to share knowledge. We also use them as a sounding board for ideas on how we can be helpful for youth savings initiatives, including what tools we can develop. And we encourage banks to join our youth banking network. I see that I'm out of time. Thank you, everyone, for your attention, and I'm going to hand it over to Steph.
Hi everyone, my name is Steph Harrell and I support community partnerships and financial literacy with UW Credit Union. And I'm just going to take the next couple of minutes to kind of build upon what Luke and Madeline were discussing as far as the research and the support of school-based financial literacy partnerships and kind of give examples of what that looks like in practice for us. And really, being UW Credit Union, we got to start from the beginning we started our education-based financial literacy on college campuses. In 1931, we were founded by UW-Madison faculty and staff, and it was in the early 70s when those staff started to realize that there was really a need to serve college students as well. And that was a time when it wasn't that common for financials to provide products and services to undergraduate college-age students. But the faculty and staff who founded our organization and the staff thereafter noticed that this was a group that could really benefit from financial literacy. And so a few steps from the elementary school programs Madeline was discussing, but in the 70s, a time when there was really a need. And since then, noticing that there was a need to serve other campuses. And so that's really where our focus has remained, in partnering with and serving college campuses. And this practice made sense because traditionally students came to campus or people graduated from high school, and that's when they opened a bank account because they were either getting a job and starting to get a paycheck, so they opened a bank account, or they came to campus and it was time to establish a relationship with a financial. And additionally, this is a time when students are at high risk of making or highly vulnerable to making decisions that will have negative financial consequences that can last a really long time. And so our social mission being related to financial literacy, it really felt like a fit that existing on college campuses we could provide as a financial literacy resource for members and non-members. And so our branches we're on 6 UW system campuses and Madison Area Technical College. And our branches are located on campus and usually around a student union or in the student union. And the idea being that students, faculty, and staff can stop in and ask questions and get advice related to their finances. But we also recognize that it's really important not just to expect students to come to us, but that we need to go to them. And so we've provided financial literacy in spaces where students are already meeting. So we talk about credit and budgeting, student loans in classrooms and with student orgs, and really bringing the financial literacy outside of the branch as well. And so last year, for example, we provided financial literacy to almost 11,000 people in person, and the majority of that really happens on our college campuses and with students. And so this is kind of what our model has proven that way, of really being able to provide financial literacy at a meaningful time in students' lives for 80 plus years. But then for a couple years, we noticed that increasingly people were coming to college and they were already banked, which for a long time was not the case. And so we took a step back to explore this trend, and it became clear that contrary to the past, students were starting to work at a younger age, and even for those jobs that maybe students held in high school traditionally in the past, that more and more jobs were requiring direct deposit. So this means two things. Number one, students need to open a bank account in order to get paid for their work. But it also means that students are making financial and money decisions a lot sooner. And so it increases the need for financial literacy sooner. And we realized at that point that this was happening, and we knew that related to our social mission and our commitment to financial literacy, that we wanted to be able to provide support for that, but we weren't quite sure how, where, when that would fit. And then there was a few opportunities occurred last year. So in 2017, Assembly Bill 280 was passed, requiring financial literacy in K-12 public schools. And so again, we knew that requirement was coming to our school partners across the state, but that likely they would need resources and support to help fulfill that requirement, and we wanted to be able to provide that support. And then also Middleton High School, which Madison is our biggest footprint for UW Credit Union, Middleton High School had decided that they were interested in enhancing their existing financial literacy programming by adding an in-school branch. And so they put out an RFP, and we decided to respond to that. And there were other financials in the process that had existing high school branches, and we did not yet. But in speaking with Middleton High School, they learned about our history of financial literacy and were interested in actually our connection with the Center for Financial Security and really our work with UW system. And so we were fortunate to partner with Middleton High School, and we just opened our first in-school branch this past January. It's open daily, Monday through Friday, during the lunch period. So again, like Luke and Madeline pointed to, it's really important to be open and accessible to students when they're available. So it's every day of the weekday, and over that lunch period to really capture and be accessible and open to students. We also hired student intern staff. So again, that peer-to-peer support, and 3 of these interns support our lunchtime branch hours in school, and actually 2 others are working in our community branches. But in addition to staffing our branch, we also really love working with them to identify creative and different ways for us to promote financial literacy in the school. Middleton High School is doing a lot. They have a financial education and economics class too that students were already taking. But students have a lot of different creative ideas, and students know what's best for other students as far as the most optimal places for them to receive this information. And so we've been working with our first cohort of students to develop a plan for next school year and kind of try out some projects for this year. And additionally, it's been a really great mutually beneficial partnership in that these students are getting a great professional development opportunity. They're also getting exposure to different departments and employment opportunities throughout the organization. And it's always just fun having the younger energy around. When they come to our headquarters, our employees get a lot of energy from meeting with these high school students as well. And then, so the financial literacy piece of the partnership is that it's really a collaborative process. Like I said, there was already quite a bit happening at Middleton High School, but they really wanted to enhance by our partnership. And it's become kind of a mutual learning lab experience because while we've done a lot of financial education and financial literacy on college campuses, we are really excited and eager to partner to be better equipped to provide it with high school age groups. And at the same time, while Middleton High School has already developed a lot of really meaningful financial literacy work, they are really excited to partner with us and our financial literacy expertise to further enhance and improve and increase their programming as well. And just kind of wrapping up and looking ahead, it's lessons learned, but mostly lessons we're still learning since it's a new partnership. And kind of what Luke pointed to, there are a lot of, in approaching this, kind of wondering the best practices of how. And there's research that points to that, but it's also a matter of getting to know the school that you're partnering with and the school getting to know us as an organization so that we're working collaboratively to really figure out the best fit for the students as well as the faculty and staff of the Middleton Cross Plains Area School District. We historically have had only custodial accounts to serve the high school population, so we're in the process of developing accounts catered for high school students that are non-custodial accounts and setting these up in a way that will only allow positive banking behavior for students so that they're getting into the practice of being able to utilize those types of accounts and get familiar with financial services. And then moving forward, looking for an opportunity to expand, and the focus is really within Middleton High School, exploring some of those seed deposit ideas or incentives to increase interaction with financials, and that's really partnering with Middleton High School to identify the best opportunities that meet the needs of their students. And also the work that we're doing here, looking to learn, create, and build out high school-based financial literacy so that whether or not it's another in-school branch, that we're really able to work with high schools across our community to provide increased financial literacy. So it's been a really positive experience, and we're looking forward to continuing that journey with Middleton and seeing what comes next. So I'm going to pass this back over to Hallie, and I think we have a few minutes for question and answer.
That's right. Thank you so much, Steph. Thanks, Luke and Madeline as well. I'll jump right in. We have time for just a couple questions. So I'm going to first send one right over to Madeline, and this is a question having to do with if you were able to measure, or if you were, well, from the studies that you evaluated for your field study, were you able to in any way see or measure effects that these programs had on parents? So parents' behaviors, or how conversations might have occurred with students outside of the classroom with parents, and so any kind of spillover effects into the household.
Yeah, that's a great question. So the only way we were really able to get at that question was by looking at the allowance, so whether kids were receiving an allowance or other pocket money at a higher rate after the bang-in schools were put in place. We didn't track any other parental, like kind of financial socialization type of behavior that I think the question is pointing to, but I think that is definitely an important area to explore in future research and as we continue to evaluate these programs.
I'm going to go ahead and also ask this of Luke. Luke, in your study, in your pilot, did you see any of the kind of spillover effects with, outside of schools with parents, maybe starting to talk about this somewhat taboo topic of finances with their children since they were gaining the exposure in school?
Yes, definitely. Some of the financial institutions shared with us spillover effects. There were definitely spillover effects within this classroom walls. I mean, one student definitely, bank shared with us, definitely had a positive impact on their peers, but then there was some anecdotal reports of parents getting more engaged, parents asking questions, account relationships being developed. So definitely, while the study was not designed to get at that, we definitely saw spillover effects to the families of young people.
Great, thank you so much. And then I'm going to send a question over to Steph. So it's very interesting that, being able to hear about these younger students that are given access to banks, through Madeline and Luke's presentations. And since your experience is with an older population, with high school students who are getting ready to, kind of go out into the world, are the bank products, or actually the bank kind of access, tailored differently to this group of students? So for instance, do they have access, are they learning about, ATM access and maybe even some more kind of mature type of accounts, like maybe even IRAs or things of that nature?
Yes, that's a great question, and that is the ideal in what we're working on. They're absolutely getting exposure and education around traditional products and services that, especially as they move into further adulthood, they'll be engaging with. And that's in partnership with the classroom teachers that they're already working with, as well as the students in branch, and partnering in financial literacy, and at the same time developing products and services that are catered to where they're at currently in their life and their financial journey, so that we can set them up for success now and help them kind of know what sort of product, services, retirement options, things like that they should be looking forward to and using in the future.
Excellent. Thank you so much. You know what, you guys, I'm going to go ahead and call it right there just so that we can stay on time. But I really appreciated all of your insights and in that kind of short Q&A session that we took part in. And if there are any other questions that come through, I will pass those on to our presenters in case there are some burning questions that must be answered individually. I would like to again thank Madeline Lesperance, Luke Reynolds, and Steph Harrell for participating today, for your excellent presentations and all of this valuable information that you shared. And thank you to our audience for tuning in. And just a reminder, this webinar was recorded, and I will be posting it on our website later today, cfs.wisc.edu. And with that, I would like to say enjoy the rest of your day, and thank you again.